Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Etienne, welcome to the show.
Thank you very much, Owen.
Yeah, it is indeed a great day. We've had a chat before. We spoke off air. I've learned a few of your hobbies outside of investing, learned about the companies that you're interested in. And so we're going to talk about your journey. We're going to talk about some higher level stuff around earnings, how to value fast growing businesses, technology companies and the like, how maybe not to do it. And then we're going to dive into some examples that you've provided. And those examples can illustrate lessons learned about different business models, about capital light business models. The first thing to talk about, I guess, is how did you start on this journey?
Well, I think it's, everyone sort of starts in investing, or many of us, I suppose, starts in investing sort of at some point you read Buffett and Munger, right? And I'm no different to that. The specific point that I would sort of say the bug bit me was in 1998, sort of leading into the height of the dot-com craziness, my brothers in South Africa listed a tech company on the Johannesburg Stock Exchange. And I remember very vividly, letters were written and whatnot, but I was sort of pulled out of school that day, told to put on a very ill-fitting suit and tie, and off we go to the JSE. And then, the equivalent of the bells ring and the thing starts trading. So that was really sort of my first introduction to, markets are kind of interesting. It wasn't so much a question of like, it's a venue to compound wealth or anything that you've obviously learned over time afterwards. It was more of this is a really interesting thing to a young kid who's basically trying to figure out like, well, what does he want to do with his life? Seems to enjoy numbers. And interestingly, this was not just a pure numbers gig. It was numbers to some extent, but there was, understanding how businesses worked. And that was sort of a eye-opening moment for me. So I'd say I'd start there. I certainly wasn't ringside for the dot-com bubble, but I certainly had probably 2 rows back seats from like all that craziness through my brother's sort of lived experience that they tripled or quadrupled and then promptly fell off a cliff, but as you do.
Yeah, right. So you got that first-hand exposure to the business side of investing, seeing how that all takes shape, where I think a lot of people in our industry come at it from the other way, right? They come at it from the numbers and the quantitative, like I'm interested in maths, investing in finance sounds like something I should do. Whereas you've come at it from a business and seeing that in your family. So was anyone else involved in money or investing in the family?
No, not really. So my brothers were involved in business. My dad studied law, essentially. So it wasn't really so much that was a family thing or anyone was sort of like, a generational, imperative to manage wealth. If anything, the advice I kind of got and followed ultimately was, look, do the very solid but kind of boring thing, which is go and study accounting, right? It's a great foundational way to sort of get exposure in business, and you can always sort of decide where you want to go later on in life. I knew very early that I was going to be a poor auditor. Accounting is the language of business. I completely understand that, and we accountants do a vital job in the sort of the role of market. But I knew that I would just be a very poor not cultural, but sort of I'm not a good fit for sort of ticking and bashing and doing auditing for the rest of my life. So what I ended up doing is study the accounting thing, and then as opposed to going sort of to a Big Four type auditing firm in South Africa, you could also get your chartered accounting qualification by going to the big banks. Effectively also offered programs. So I ended up going to one of the biggest South African banks, and sort of there's cohort intake of 10 or 12 every year, and they move you around the bank. I did my time in audit. Was not the greatest time of my life, but obviously, you learn a lot of stuff that's vital that you can apply now. You do group finance, you do corporate investment banking. The real thing that I was sort of trying to angle for, and ultimately, very fortunately, got right, was that the bank owned in-house a high net worth private client asset manager. And I had my sights sort of set on that from day one. So sort of a lot of finagling and introducing yourself to the right people, make sure you get a rotation there, and then obviously you kind of got a 6-8 month period where you have to really prove that you can do it. From there on, it sort of went that I was very fortunate to get involved in the investing world, and they will, sort of fulfill that sort of passion to get into investing, which is, as you would know, not the easiest thing to get into, professionally. There's a lot of barriers, and there's obviously a lot of people jockeying to find a role in the industry.
So what were you actually doing there?
Look, in the beginning, anything from like doing the morning coffee run and printing out people's mail so it's on the desk essentially in the morning. Effectively, the period that I joined, they were looking for someone, ironically, to start covering tech stocks. And the South African Stock Exchange is not exactly a hotbed of, tech businesses. But they thought I had some pedigree, given that, my brother's listed a tech business. That was thankfully not the only reason, but like I sort of kept up my interest, and I would argue that thinking of a specific person, but I would argue that they would say I at least had a better sense of sort of, how the world seemed to be shaping up, post, in a GFC world, and how technology was evolving. And you're the young kid, right? You basically go, well, you're plugged into all of this stuff. What does it actually all mean? So I was fortunate enough that, you do the donkey work, you learn how to settle a trade and all that stuff. But also, they basically said, look, we need someone to start looking at some of these companies for us. And obviously, if you're a South African investor, Naspers was massively important to you. And if you own Naspers, you really have to have an understanding of Tencent. So I initially assisted the analyst who covered Tencent. Eventually, a couple of years later, I took that over. But what also happened at the same time is that there were some changes to South African exchange control legislation, and individuals, high net worth individuals, could externalize and invest a lot more money offshore. So there was a decision sort of taken to say, okay, we need to build our own global equity capability in-house. Previously, it was sort of you sell a white labeled fund, someone else sitting in New York or London runs it for you. Over time, we'd like to do it ourselves. So they kind of hired me to sort of be, okay, when that happens, we need someone who's got like a year or two under the chair, like looking at global tech. So that's basically, for the first couple of months, ran hard, tried to initiate on, anything that I could sort of get a handle on, and was considered by the sort of metrics that they would want to invest in, which is sort of high quality businesses and the like, and that's how I sort of got my start there, and then, turned into a permanent analyst role.
We spoke off air. It's interesting. There was a phrase that you had yesterday, which I'll maybe let you repeat, which is the differences between working directly with clients and working in a funds management business or even in a pension fund or something like that. Can you just tell us a little bit about that relationship and how that formed you and the investor you are today?
Look, so I think that the most important thing I would take away from my time with my former employer in South Africa is because we were not to the extent that the funds management industry is normally disintermediated from the ultimate investor, right? So there's a consultant or there's an advisor or there's an allocator between you and the client. In our business, that was not the case. You met clients, and our chief investment officer was very firm, and you only figure this out years and years later when you've had some time in markets, why, even as a junior analyst, you would go along and, start building a relationship with the clients whose portfolios you're involved with, right? Because it's a very different thing telling you what I've done with your wealth if I have to look you in the eye. And that's a really important lesson, I think, that I took away from my time with my former employer, because when you start, sort of meeting people and hearing their stories, the fact that, this was someone who worked for 30 or 40 years, they've now retired, but they've built up, this is their wealth, and they're really entrusting it to you. And, they have aspirations of their own, right? It may not be like as simple as we want to do an extension of the house or go on a yacht cruise or whatever. It could be, we want to send our grandkids to Oxford, right? Once you start having those discussions, you meet the grandkids. You, like many times, clients did not come to us. We would have clients all over South Africa. So you'd go out to, the Free State, to like some guy who's basically retired to a farm. You meet the grandkid, When you get to that point, I think you start realizing the message our CIO always drummed into us, which is like, this is not your money. This is someone else's money. And you are not being paid to try and be smart with someone else's money. What you're here to do is make sure that we compound that in a reasonably low risk way so that these people who have worked hard and entrusted us with their wealth can have the retirement they dreamed of, right? And I think as soon as you get that into your head, the biggest takeaway for me was like, we are trying to compound people's wealth. We are not trying to win the annual horse race of performance, because those are not the same things. And once you sort of get that, I think a whole different world of investing opens up to you. And really, that's sort of, I would say, the main takeaway that I've even brought with me to AIM.
How does that change you? Because there's a dichotomy there, maybe annual performance and compounding. How does that, and being in tech, I imagine that was seen as maybe the higher risk kind of, this tech thing is maybe going to come and go. And, how did that impact what you were doing and then the way you were investing?
Look, so I think that there's a couple of interesting points there, right? The first thing is we were set up as sector specialists. And over time, I was fortunate enough to sort of move through the ranks, and I became a portfolio manager of our global equity fund. And by definition, then, you take sort of your view has to take a step higher, and you need to be more of a generalist. I would today classify myself more as a generalist investor than just pure tech specialist. But I think the point is that, back when I started out, tech was not yet the be-all, end-all. Everyone needs to own as much tech because it's the only thing that works, that we've basically had the last 2 or 3 years. So back then, it was really about sort of finding businesses where we could get a head around the valuation, understand sort of classic, what are the moats, why this business can continue to earn high returns on capital through time, very basic meat and potato stuff, right? What I would say is, to your question about like, what does that actually change, is once you no longer feel the need to be in front of your client every year saying, look, benchmark's up 12, I'm up 15, pay me more, and you build the relationship with your client, I think you start building a relationship of trust directly, where they understand what you're trying to do with their wealth, and therefore the expectation does not become you need to be ahead of the benchmark every day, month, week, second, right? And again, there's a British investor, I'm not sure if you're familiar with, a guy called Terry Smith, who's built a fantastic track record out of the UK. He's got this great analogy about sort of long-term investing is like the Tour de France, where the Tour de France, there's different stages. You get, the sort of the speed, the time trials, you get the climbing stages, you get the flat sort of races. The point is, no one body type or physique is suited to win all 3 of those. And the Tour de France has been won many times by someone who's never won a single stage. The trick is to be good at one thing, okay enough at the others to keep in touch, but know what you're good at and make sure your client knows that so that they have the right expectation. So I think that was super important, because that's how you get clients on side during periods when markets are tough. And that's easier said than done, but you need that, because in my opinion, the best investment strategy is the one your client can stick with. If they get shaken out at the wrong moment in time, that's normally when you crystallize losses at the wrong point, right? You become a forced seller. So a lot of work to sort of make very transparent effort to make people aware what you're doing with their wealth. That's probably the main takeaway. For sure.
We'll get to how you go about assessing companies, in particular, faster growing capital light businesses. But I'm just curious to know, and I think listeners would be curious to know, why you came to Australia.
Look, I mean, I would not be alone as a South African sort of saying, like, the economy there has obviously been challenged for a long time, particularly post-GFC. And without going into too much detail, look, the security situation, also wasn't great. And then obviously, sometimes it fixed, people close to you. So ultimately that was sort of the decision, without sort of getting into the nasty details.
Yeah, for sure. So you're here at AIM, we're recording in the office today. The team has grown over the last few years, but you've kind of taken on this role and it's kind of invigorated the team and definitely helped Charlie. Tell us a little bit about this kind of higher level topic, which we spoke about, which is basically trying to use earnings to assess the value of businesses, to forecast and model. I know this is something that you're passionate about. So tell us about the problem with using that concept and how maybe cash flow and other metrics matter more.
Okay, so to start off that discussion, the first thing we have to kind of set as the ground rule of any sort of discussion is, fundamentally, I believe, and we all here believe, that intrinsic value is essentially the present value of all future cash flows that you can take out of the business, discounted to today at an appropriate rate of, so nothing too earth-shattering there, right? I think that the problem becomes, though, that if you look at earnings, so financial news is very sort of income statement focused, right? It's all about what did revenues do, what did earnings do, maybe someone says something about margins, we move on. You missed by a penny, you beat by a penny, that kind of stuff. The problem is earnings has, in our opinion, a lot of deficiencies, right? The first problem with earnings is earnings does not capture the fact that there's a cost of capital assumed. So again, without going too deep down the rabbit hole, you can generate earnings growth all day long, but it's not necessarily creating value for investors. And there's tons of ways you can do it. Value destructive M&A is probably the obvious one. But you can do a lot of damage to investor equity if you essentially invest at rates of return below the cost of capital, but hey, you can show earnings growth all day long, right? So that's the point.
Can I get you to double click on one thing there?
Yeah.
The destructive value. Can you explain what that means?
So essentially, very basically, right? Let's just use a round number. If your cost of capital is 10%, right? And I'm sort of jumping ahead to a conclusion I was going to present later on, but like, if you invest a dollar of capital and it does not generate, if it generates exactly 10%, the dollar of capital you've invested, if the return it generates is 10%, then quite frankly, you may not as well have invested it. It's the idea of basically saying, I've got 3 bank accounts. This is actually probably the best way to explain it. The first bank account, I've got a great way. You earn 2% on your bank account. I can double how much you earn. Here's the trick. You just put in double the money, right? It's the same idea. So if you're earning 2%, you're earning 10% cost of capital. Even if you double the amount of money you've invested, you haven't actually created any value, right? A better bank account, better business, is one where you can say, look, I want to invest X. My opportunity cost is 10% or 2%, but then what I earn is higher than that. So that's creating value, right? So when you take a dollar of capital, you invest it in the business, and the dollar of capital earns a return above your cost of capital. And alternatively, you can quite easily, and this is what I was saying, sort of earnings accretive but value destructive growth. If you invest and your return you earn is below your cost of capital, you're actually destroying shareholder value. And it's a concept that doesn't come up, I would argue, enough in sort of financial reporting, because again, this is all sort of wonky, and you start looking at the balance sheet and capital efficiency and all that kind of stuff. But the point is basically this: what you want to own are businesses that can consistently earn the cost of capital plus a wide spread, because they are adding value for shareholders every year. And that's a large part of the focus we have, is focus on those returns on invested capital.
Mm-hmm. How do you measure that?
So it's essentially some measure of profitability. And again, you can get very detailed on this stuff, but let's just say it's some measure of profitability divided by some measure of the capital employed in the business to generate that. So if you break that down a little bit, let's use a very simple way of doing this. Let's say it's net profit divided by sales. So that gives you some level of, for every dollar of sales you make, what is the dollar of profit you have at the bottom. So let's call that net margin, multiplied by sales over capital. And again, you can do that with assets, you can do that with invested capital, which is of equity and debt capital. But that is basically saying to you, for every dollar of capital you have in the business, how many dollars of sales does it generate? And if you cancel the two sales figures out, you get sort of net profit over capital, right? So the easiest way would just be ROE, return on equity. So if you take net profit and you put it over the equity capital, you will get a measure of what is this business generating on the equity capital that's invested in the business to earn a profit. Obviously, and the reason we favor return on invested capital is because it also includes debt capital. Given how low interest rates have been the last decade, many businesses have availed themselves of sort of the idea of you take on debt capital, buy back equity, you can artificially inflate the ROE almost to infinity, right? So in our opinion, you have to look at the total capital structure. And again, you need to make some adjustments for, the fact that you need, your free cash flow is not to equity owners, it's to the firm. And again, without getting into all the detail there, but that's basically what we look for. So you need to look for businesses that earn a return on invested capital that's well above their cost of capital sustainably. Once you've got that, you've got a good business. Once a business can earn a return on invested capital sustainably above its cost of capital over a long period of time, it's also suggestive of the fact that there's a moat. So then you go digging. And again, that I think informs a huge amount of what we do. It's not so much the rate of growth does not matter. It is what is the returns you're earning on the incremental capital you have invested to generate that growth. And if that's not above your cost of capital, like there's no point in doing it actually. You're better off just giving the money back to shareholders.
Right. Okay. How do you determine discount rates?
Look, so I think there's a couple of ways you can do it, right? So the first is you can sort of back it out from market implied expectations. And we definitely use a lot of sort of market implied expectations, even when we try and value businesses. But you can do that sort of saying, look, the US 10-year is here, implied equity risk premium is here for the market, and then you can use sort of historical beta. I think what we do is slightly different in that what we like to think of is we want to earn at the point we allocate your capital a specific IRR over time. So we're very much aware of what sort of a market-derived cost of capital is at any moment. But for us, we would like to probably have a hurdle rate of between 8 and 10, and in some cases and in some industries, even higher percent before we would, allocate money. But I would say the primary tool is we've got an IRR target, and then we sort of back it out from market implied expectations, and you can sort of see where the two meet.
Do you ever use the phrase expected return when you think about your discount rate, as in this is the hurdle that we need?
Yeah, so that's basically the IRR hurdle we look for. It's sort of 8 to 10%, and depending on the riskiness of the business, it might be more. So we definitely use that in. I think what we try and sort of say is over time we would like to generate a return for clients between 8 and 12% through a cycle. If you can do better than that, obviously that's great. But at the point you allocate the capital, you would at least want to see a pathway where you can earn, depending again on business nature and growth rates. If you can't do 8%, in my opinion, you're beginning sort of, if you're wrong, then there's a lot of room for error in terms of your margin of safety.
Yeah, right. There are so many threads that we can pull on here. I just don't know how deep we want to go. But so when you look at companies, when you're trying to find ideas, do you use screening tools to try and find high returns on invested capital and then start the process? Or do you start it more qualitatively, look at the business model, what does it do, what type of industry is it in, and then work down from there?
So again, I think it comes back to sort of saying we look for certain things in the businesses we invest in. We call it sort of our 4 quality criteria, right? The first is high returns on invested capital, or at least sustainable high returns on invested capital that beat the cost of capital through a cycle. The second is the ability to generate free cash flow, which dials back to our earlier point about why we think earnings is the wrong way to evaluate the business, right? Because earnings, in addition to not looking at, if you at least do a DCF, then there's implied in that there's a discount rate somewhere, right? If you just sort of do earnings and slap a multiple on it, not happening. So we look at free cash flow. Other reason free cash flow is important is because at least with free cash flow, you get a sense of the business's actual cash cycle. That's going to be important when we chat later on about sort of, evaluating capital like tech businesses. Because again, for many of these technology companies, they actually receive the cash well in advance of them being able to recognize the revenue or the profit on the income statement, right? And if you're not looking at the cash flow, you might miss that. So at least free cash flow gets you over the line in terms of saying you're looking at incremental investment in working capital and fixed capital if that's required. And then sort of finally, the problem with earnings is that ultimately there's different ways to calculate it, right? And they're all equally valid in terms of GAAP. So we focus on free cash flow mainly because cash is oxygen, as everyone discovered the hard way last year in about March, right? When the chips are really down, the people who have cash in hand or are generating free cash flow, that matters. Earnings, bank doesn't take earnings. They would like to be paid in cash for the debt. Thank you very much. So we look at ROIC, we look at free cash flow, and then I would say we do one final quantitative thing, which is we sort of try and control for balance sheet risk and make sure that there are no sort of off-balance sheet liabilities or anything funny going on there. And then you really get into the more qualitative stuff. And again, sometimes we do both to answer your question. There's a quantitative screening process, but anyone can replicate that, right? So you've got a Bloomberg or a FactSet, you can just pop in the parameters you want and off you go. So what we tend to do these days is, we all know what sort of the quality type businesses we look like. We tend to actually say, well, this business would meet those quantitative criteria, but how we focus our effort is a lot more driven by the qualitative. To try and sort of understand, well, okay, so management and management integrity and their capital allocation track record is hugely important. But also there's, sometimes let's call them quality patterns in the businesses we look for that actually suggest, this is something you should do a bit more work on. A simple example would be some sort of like the classic pick and shovel, a low percentage of the client that this business sells to's cost to deliver their product. So you're a small part of their cost base, but without you, they cannot function, right? That's usually in sort of more industrial businesses, we find a really good sort of way to say, well, does this business tick that qualitative box? Okay, let's go and do more work.
I think there's one company in here that does that, which we'll get to in just a moment. It's kind of that low cost to high value, that relationship, if they can be mission critical and inside the kind of the ecosystem of the business they're serving, right? How about this? There's this interesting thing in here, a comment that you sent through by email to me. You said, why value versus growth is the wrong debate. I was fascinated by that.
So I think it comes back to, and again, now I'm going to misquote it probably, but like 1992, Berkshire Hathaway let its shareholders. I was going to quote Buffett eventually. Like if he basically got $1 every time someone quoted him, he'd be even wealthier. But anyway, the point basically being sort of value and growth joined at the hip. You can't separate the two, because for the way I've now explained sort of earlier, that growth can either add a huge amount to shareholder value if it's done at incremental rates of return that are above the cost of capital, or it can destroy value. The basic point, however, is that buying statistically cheap stocks, low PE, low price to book, is no guarantee of a value purchase. Equally, buying a stock with opposite metrics is no guarantee that you're a growth investor. The two are linked, and without actually sitting down and trying to understand the interaction between, the capital that's required to grow, what those returns are that it's generating, like the value growth debate has sort of become, it's like the original meme stock, right? It's basically either you buy really cheap, statistically cheap stuff, or you buy something that is just the opposite of that. Growth is always sort of very poorly defined. But it's all basically come down to sort of these factor engines, right? And, there are many factor investing styles in the market. That's fine. We would say that gives people who do the fundamental work bottom up the opportunity to find businesses that could be on the more expensive side, but actually they're worth that. And there again, there's a lot of qualitative stuff, because the numbers, anyone with a laptop can get the numbers, right? Turn off the laptops, go and think, go and do the work. The qualitative work, that's where you'll find the opportunities. So in our opinion, growth versus value, particularly on the value side, most people think value is buying cheap stocks. That's the value factor. I would argue that the value investment approach is much more just buying something for less than its intrinsic worth. That does not mean you pay 10 times earnings. It helps if your starting valuation is cheap, but again, something that's a lot more expensive could also be worth a lot more, but optically people would say, oh, that's not value investing. So we tend to think of it sort of, it's a continuum, and we look for the quality. So you can find quality at the statistically cheap end of the market. You can find quality businesses at the other end. So we're not pay anything investors, to be very clear about it, but there are businesses where if the supply side of a business that's expensive, but if the supply side of the industry they operate in has huge barriers to entry and rational competition, high multiples can be justified. Because your biggest problem is if you get a whole host of new supply coming on stream, and then sort of that's when you erode and compete away the incremental profitability to the cost of capital. But, there's an example of a business we own called Heiko, and they make basically parts that go into airplanes, to keep it very simple. Now, the reason they can earn acceptable returns on capital is because the barrier to entry there is you need FAA approval for every single part that goes into an airplane. And they have built up decades of experience, and they have essentially all that IP in-house, but also they've sort of got the process down to get it approved. And you and I are not just basically going to go with the best will in the world. We are not starting up a business that competes with that today. And if someone looks at that, they might also say, look, you can compete with these guys. We're going to take years and years and years to actually build a credible offering. Why would the airline switch away from someone like a Heiko, and so forth? And then you couple that with a really aligned management team who know how to allocate capital. We think that's a great business model to own.
Yeah, there's so much there. I think one of the things that I think people get tripped up on, which I think you talked about there, is basically you study the returns on invested capital, but if you're investing in a company that is growing, the earnings can sometimes be very depressed. So if you can try and find a way to sidestep that, you can get a clearer view of what's actually happening under the surface, right?
Yeah. So this is, I think, what we were sort of alluding to earlier about sort of saying, how do you try and understand the economics of fast-growing, not profitable businesses, right? So let's take a gigantic step back for a second. Accounting as it exists for the large part of the last century was focused on sort of traditional brick and mortar businesses, right? So if you're a retailer, you basically have to probably pay for the physical space. You have to fit it out. You need to pay for delivery trucks, whatever the case might be, right? So the income statement was a really good approximation of the economic profit for a sort of brick and mortar type business, because the investment happened on the cash flow statement. And you had to obviously go and look at that because it could be very capital intensive or not. But ultimately, the way the accounting rules work, it favors sort of like traditional business models, right? Mm-hmm. The thing that's changed, and to be very clear, I'm not sort of a voice in the wilderness saying this, very respected people like Aswath Damodaran, who's obviously professor of sort of valuation at New York Stern University, people like Michael Mauboussin, I can cite chapter and verse, other authors and books, have basically made the point that businesses that rely on intangible assets work slightly differently. So the obvious example, I'll give you a couple actually. So think about a business like Nike, right? Nike's value really lies in the brand. However, all their expense, for what they call a demand creation expense, just goes through the income statement. But if you think about it, some part of that probably is building up let's call it an intangible asset, the brand asset, but that you expense it in full and it doesn't get capitalized. Now, the reason it doesn't get capitalized from an accounting perspective is because it's obviously very difficult to sort of say, well, what is it actually worth, right? And again, I'm not trying to assign a market value to any of this stuff. Equally, if you're a fast-growing tech business, right, what are your expenses? It's probably R&D. It's probably some sales and marketing. Maybe some of your general and administration costs. But certainly on the R&D side, I would argue that for many tech businesses, that's the lifeblood, right? Now think about this. You're investing through the income statement, not through the cash flow statement. All of a sudden, your profitability is going to look very depressed because you have to expense all of your investment. So the way you get around some of this stuff, and the reason we're comfortable in doing this is because it doesn't actually change the free cash flow. All it does is it moves around some items on your income statement, free cash flow line item, to basically say, okay, if you assume, and this is where obviously the work happens, if you assume that, pick a number, but let's just go with 50% of the R&D that a fast-growing tech company is spending on every year is actually creating an asset, the intellectual property that will pay off over 2-3 years, then in theory, you should be taking that out of the expense item and you should capitalize it as you would any other investment in the business and amortize and so forth. So the point is not to basically say, oh, I can see what's happening here. We're late in the cycle. You're basically adding back costs to try and sort of prop up earnings. Again, it doesn't change free cash flow. But what you're trying to get to is sort of saying, what are the stay-in-business costs of any entity? What are the investments? And then if you sort of split those out, you can kind of get to a point where you say, well, we think this is sort of the normalized level of profitability. So to our earlier point, now you've got some measure of profitability. And because you've now gone and capitalized a lot of what was previously expensed through the income statement, it goes into your invested capital base. And now you can finally sort of take a view on saying, well, what is the return on invested capital this faster growing business is earning? And it might be that these guys are earning a pretty respectable return on invested capital, but you have to go and do that sort of level, like take the statements and sort of pull it apart. Where does everything go? And then you can have an informed view on whether something is expensive or not. The classic example, to give you a very brief one, would be a software as a service business, right? Software as a service, generally you receive, in many cases, the revenue or the cash comes in upfront, sort of billed annually, right? So you get a big slug of money on day one, but on the income statement, you can only recognize the revenue in sort of increments of a 12th as the months roll along. But, the money's basically already come in. And then what you do is you take that money and you spend it on R&D and sales and marketing. And therefore your profitability on the income statement looks zero or even negative. And if you then say, okay, that actually should sit down here, where it normally be on the free cash flow line item calculation as an investment, then you can kind of say, well, this is my measure of profitability, capitalize the investment. And again, this is all very subjective and you're not trying to sort of come up with saying, oh, capitalize 100% of R&D, because some of the R&D may not be worth anything. But at least it gives you a sense for how profitable the business is in economic sense. And then you can sort of make a more informed view of saying, look, is this a fast-growing business with legs that you want to do more work on? And again, it speaks to our earlier point about quality as a continuum, value and growth at either end, but you can find businesses that are fast-growing and generating good returns on capital, but you have to pull it apart and sort of do the analysis.
I think it's actually a really interesting segue into Microsoft, which is, I know, a company that you wanted to talk about, because seeing Microsoft evolve over, say, the last decade, we've seen it go from PC to shift into the cloud, basically all of its products. Each of these companies that we're going to talk to from here on, you'll have basically a description of what's going on, what's happened with the business today, and then the key lesson or takeaway there. But Microsoft is one I know you've spoken about before. So, and I think this lends itself to that discussion around what is creating value inside the business and what isn't. So maybe I'll just allow you to just riff on Microsoft for a little bit.
Yeah, sure. So again, this is a great example. If you go and look at Microsoft over the last decade, I remember sort of initially purchasing it 2011 or something, when it was an actual legitimate, trading on 10 times earnings value play, right? So it's been a fascinating sort of story if you've held it on over the decade, because clearly, that the business has changed dramatically, but also it started off where a lot of people who would think of it as traditional value stock. And I remember very much why. I mean, people talk about, the mega caps and their very consensus longs and all that stuff today. They weren't always the mega cap FANG stocks. They started off at, much more reasonable valuations, and certainly the market cap was a hell of a lot smaller. They grew into that, right? But I think the main point would be that for Microsoft, there's two things I would say that's important to sort of understand about Microsoft's journey over the last decade, and then you can get to where they are today. The first is obviously their transition to the cloud, and it happened sort of before Steve Ballmer left. Clearly, they had to put a lot of that in place, but really under Satya Nadella, that's accelerated. And I think he should be credited probably for one of the best, if not the best, in my career that I've seen sort of turnaround in terms of like the corporate mindset and culture there. Again, when you speak to people who work there, they all sort of attest to the fact that it's a very different organization from sort of like the mid-2000s Microsoft, because the realization they had was like, we have great products. We have products that people want to use. They're industry leading. They are incumbent, given our sort of dominant, position in enterprise IT. But we tie everything to Windows, right? And Windows may not be the optimal solution in every single use case for all of our clients. So by sort of embracing that more open approach and sort of releasing the iron grip that Windows has to be the center of the universe, that opened up a lot of opportunities for them, and obviously with part of the cloud transition. I think the other thing is they then went with a SaaS transition. And again, how that normally plays out, and as an investor, I've seen a few of these now, initially, it looks terrible, right? Because what happens is you go from a model where you booked all the revenue effectively up front at very high margins. All of a sudden, you have to start booking the revenue in increments. So revenue goes off a cliff. On day one, your margins probably also compress as a result, because you're not spending any less, right? And then you sort of need to annualize that through the entire user base over a period of time. And then as you come out the other end, your margins start lifting up in your revenue, now that you've got sort of 2 or 3 years worth of revenues being recognized at any one point. But the key thing to all of this is it doesn't change the cash flows, right? Because the cash, depending on how it's built, might still be coming in up front. And again, it sort of speaks to the earlier point. That's why we look at the cash flows, particularly for fast-growing tech businesses. So I think Microsoft today, look, it's sort of split into 3 businesses. I think every single software business has at least one moat, which is a switching cost moat, right? Once it's in there, it's probably a pain to get it out unless you're really unhappy. Microsoft is in a very privileged position because of its sort of historical legacy as sort of, the Windows operating system, clearly. And from that, the fact that so many white-collar office knowledge type workers are intimately familiar with its product. So that alone gives it sort of a stickiness. But also in its more like, let's say, non-knowledge worker, consumer facing businesses, they used to call it the server and tools businesses, but obviously it's essentially providing, the backbone to large enterprise IT organizations to manage their entire organization. That's where Microsoft Azure lives and so forth. And the point that I would make is that the Microsoft is a extremely competitively advantaged business simply because it started off in the on-premise world. They have very much a very strong footing in the cloud sort of landscape now. But importantly, because they are the one player that sort of has a leg in both worlds, they're probably, in our opinion, the best in sort of that hybrid where we think the world's probably moving to. right? And then beyond that, you have sort of the traditional, like there's lock-in, when a chief information or chief technology officer is worried about like deploying something rapidly at scale through an entire organization, like last year during the pandemic. The fact that Microsoft is a known quantity and their breadth is so wide and their level of support, that kind of thing, that's what provides us with a huge amount of comfort that Microsoft is going to be around. What's the risk? Yeah, so there's virtually for every one of the things they do, there's basically a point solution or a best of breed software solution that's sort of playing in their space. So I think Microsoft is probably, of the large cap tech plays, the one that you can legitimately say, look, they don't lack for competition. But we just think that sort of incumbency advantage, the switching cost moat, really sort of, entrenches that business as something we're very happy to sort of own for our clients for a long period of time still.
You said that you originally bought it, I think 2011, you just mentioned.
Yeah, well, in my previous life.
Yeah, in your previous life, for sure. When you identify these opportunities, do you think that long-term investment horizon is required? And what I mean is like this transition has taken a long time to play out, right? And it's been very fruitful as we record this. At least it's, I think it's the biggest company in the world right now. So can you invest the way you do with a shorter time horizon?
Look, I think we normally try and form a high conviction view on, let's say, a 3 to 5 year basis, right? Mm-hmm. And you have an investment thesis that will hopefully play out over that window. I think it's then incumbent on you that as the facts change, you need to sort of update your own thesis, but be very clear about a big risk, I think, is something called thesis drift, right? So for instance, if you bought something because it's a pure play on X and then they go off and buy something that's completely unrelated to X, do not fall into the trap of saying, well, that's fine, like that's what they normally would do. And then actually it's so far outside their wheelhouse, it should have been a massive red flag. So, we tend to sort of say we look out 3 to 5 years. And I think even with that, forecasting is difficult, especially when it's about the future, right? But you need to have at least a thesis. If the thesis continues to develop favorably, then you can end up owning it for very long periods of time. What I would say for Microsoft is even when it was sort of cheap at the beginning of last decade, its returns on capital was sky high, right? So you were to some extent being rewarded for being a little bit patient. And as things improved, and to be clear, there were moments where it was not particularly easy. When they bought Nokia, then impaired Nokia. There's a ton of stuff that wasn't particularly like you sit there going like, why are you lighting money on fire? But the key thing was, like I said, relative to your other opportunity set, it's not particularly expensive, and beyond that, it's still earning high returns on capital. And then obviously you had the management change, and things after that developed rather favorably. So is it easy to sort of sit here and go like, you have a 10-year view? I mean, I'm pretty sure that I can tell you whatever view I have of 2030 is wrong. But that's why we focus on what I referred to earlier as our sort of quality criteria, because in our opinion, forecasting that far out is basically pointless. So why do it? Well, we use DCFs not so much to sort of forecast and say it's going to be right. It's to understand what the market implied expectations are today. But then we want to put our thumb on the scales as much as we can for our clients, right? So you want to be sure that it's a business that even if it's not growing in a particular year, still earns a positive economic return, high returns on capital, that the balance sheet's not going to blow you up out of left field, that management are trustworthy and know how to allocate capital, and they look after. The longer you own a business, the more management's capital allocation and culture matter to you, because that drives a hell of a lot more of your return on a 3 to 5 year view than if you're just going to rent a stock for a quarter and hope it goes up, right? And then, yes, they need to generate cash, free cash.
For sure. You said to me yesterday that you, maybe before a child was on the scene, you would do a bit of gaming and those types of things. And one of the companies that you wanted to talk about was Nintendo, which we'll all be familiar with over the years. Consoles, Switch, all these different consoles and games that people are familiar with as either as kids or as adult kids, if you like. Tell us a little bit about Nintendo, because I thought this was a really interesting one, and it kind of, in a minute, we'll segue to some more industrial companies.
So what I'll start off by saying is, Peter Lynch famously said, buy the companies or the products that you see and use in your everyday life, or your kids and your grandkids, right? You might think that's as simple as this is. It's a little bit more interesting than that. If you look at sort of the gaming landscape, you can broadly sort of break it down into the fact that there are the people who own and provide platforms. So that's like Xbox Live or PlayStation Network, or on the PC side, Microsoft also. So again, Microsoft, right? But the platform economics are quite good. So to simplify it a huge amount, it basically works like the App Store, right? You provide a platform, you gather a large amount of consumers, you provide a venue for developers to sell their game, and you sort of take a spread effectively in the middle for providing all the infrastructure, downloadable content, whatever, right? That's technically a better business than the pure play traditional gaming studio business, because a studio business, whether you're doing movies or video games, is by definition a blockbuster model, right? So boom bust. Like either you come out with a hit game and you make a lot of money, or everyone hates it and you can't barely recoup the cost of your investment. So traditionally those businesses have been very like faddish, for lack of a better term. What's changed in that industry over the last decade has sort of been, okay, franchises have come to the fore a lot more. So it's sort of your annual Call of Duty game comes out, whatever the case might be. And also digital distribution, meaning that's at a much higher margin. So as these companies, the studios, have pivoted away from sort of physical distribution, that's come at a much better margin profile. So that's sort of the traditional studio outlook. The reason we own Nintendo is because it is legitimately, we think, one of the best IPs in the world. And there's not, like you can probably show someone a picture of Mario who's never held a console in their life, and they'll probably go like, oh, I know who that is, right? There are very few businesses with that sort of intangible brand recognition type moat trading at the valuation Nintendo does today. So the thesis on Nintendo is sort of built on a couple of things, right? They also had these boom-bust cycles. The Wii was a fantastic success right up until the moment it wasn't. Arguably, the reason it never sort of, after the Wii, they had the Wii U, which was a debacle of note. And the problem essentially was the control scheme was so idiosyncratic that developers simply weren't interested in developing for it, right? With the Switch, they still have sort of a unique controller, but at the very least, it maps to a game from, that works on a Xbox or a PlayStation. But having said that, that's not the attraction of Nintendo, because Nintendo is the one sort of gaming venue where you probably have the better chance of knowing that it's a more family-friendly gaming environment. So the Nintendo thesis is sort of built along the following parts. One is it's probably one of the most recognizable IP brands in the world, and they are now beginning to monetize that IP in ways outside of the core Nintendo sort of gaming console. They're releasing movies, sort of licensing, receiving royalties, that kind of thing. So firstly, that's sort of finally creating a flywheel effect where you introduce people to the IP, and if they like it, you can bring them into the core business, which is sort of the integrated software hardware. Secondly, they're finally beginning to sort of, sell more of their games digitally as well, which means same sort of margin uplift trajectory. It's going to play out over time. And then finally, what we think that they've learned after the Wii U cycle is simply to say, look, it doesn't pay to basically every cycle, every console generation, blow up your entire user base. So for the first time now, they've basically got a Nintendo account, which seems like such a basic thing, you to have your Xbox Live or PlayStation account, but that your games, your profile, all that stuff can carry between consoles, right? So effectively what the thesis is that over time, you'll still have sort of the normal ebb and flow, but those peaks and troughs will be much shallower. And then over time, it becomes much more of a stable sort of business where, every couple of years they release a new Switch, but it's like an iPhone upgrade, right? And then the only place you can get access to Mario, Zelda Breath of the Wild sequel, whatever, is there. And all that trading at a valuation where, again, if you had to do it on a multiple basis, it's sort of, pretty attractive, depending on how you define it, sort of 8 times EV to EBIT. You could argue that over the next year. So they acquired a lot of customers during COVID. This year, supply chain shortages and semiconductors, and the fact that you just have a terribly difficult comparison. So the stock hasn't done well from the beginning of the year, but that's when we started buying it. We would argue that they've expanded their user base, and as you sort of annualize that, and people who've now for the first time experienced the IP get used to it, there's quite a bright upside. And again, there are not many of these IP plays trading at valuations that I would say are very close to, if not, double-digit free cash flow yields. So it's an interesting one. It's not our biggest holding by far, but we think if we get it right, you're not only going to get the earning and the cash flow potential coming through, but the market will hopefully then sort of say, look, this is a much better business model than it was in the past, and you hopefully get some of that reflected in the multiple.
Do you say if the Nintendo thesis plays out, is the kind of maybe the house rule, maybe your personal view on this, whichever one you'd like to take, is it important to sell at intrinsic valuation, or do you are you more flexible in terms of the qualitative factors are going in the right direction? So directionally, we're still correct. We might lighten the load around IV. How do you think about that?
So we do not have explicit like target price reach, you sell it. As long as, sort of our 4 pillars of quality remain intact, we're happy to sort of continue owning it. Again, you might adjust the weighting based on, the price you're offered in the market, right? Alternatively, if you have a better opportunity elsewhere. But I think we're not, if we see something sort of re-rate, or if it achieves a price target, businesses evolve. The business Microsoft today is like, you could make the argument that, oh, I've bought and held Microsoft for a decade. Well, I haven't, because it's not the same Microsoft as a decade ago. So, valuation is one element we look at, and certainly it comes into a sense of like, are there relatively better opportunities? But do we just purely sell when it says, okay, it's hit this valuation? No. We like to sort of say, first step is, reduce. Does it still make sense? Can you earn a reasonable IRR from here? If that's a no, then we have a different discussion. But it's not a firm, you hit it, you're done.
Mm-hmm. In the case of, say Microsoft was to hit your intrinsic valuation and you think the IRR is, not suboptimal, do you continue to follow the company? So do you keep that IP, in the team?
Yeah, absolutely. I mean, I would say that there's probably at any given moment, 100 to 150 really high quality global businesses of the type that I've described out there in the world, and you might not like them today, but you need a bench, right? So even if you sell, so we like Apple, but we sold it at some point over the last 12 months because, again, at the valuation, you're basically saying, okay, either you need to believe that there's optionality built in, and to be fair, there is optionality with a cash balance like Apple has, but what are you paying for it? So again, it's more of a valuation-driven decision there, because we're basically saying, look, the people who want an iPhone will have one and they will upgrade and they will stay true to the ecosystem. But the argument is not, oh, it's $150, I think there's 20% in it, so it's $180. What you're really saying is, there's a $2.2 trillion company, I think there's 20% on $2.2 trillion. So if you back it out, what needs to be true for, essentially another $440 billion worth of market cap to be justified? You need quite a lot, right? So with Apple, it's more of a case of saying, like, we really love the company and there is a valuation, you'd buy it again. So we definitely follow it, but we consolidated that into, again, a Microsoft, I think, September, October last year.
This company, so we're going from Apple and Microsoft, Nintendo, brands that people know, consumers know, to a company called Fastenal. And this is a business we had to look up before we came on to record, because I thought I'd heard of it, and I kind of assumed something from the name, but I wasn't 100% sure what it was. So maybe you can fill us in on this thesis, because I think this is different again, and what you thought it was versus what you later turned out it was indeed, and the value prop around that. I think this is a kind of interesting story of kind of using that criteria that you laid out earlier on to really stress test your initial impressions.
So again, it's a business that ticked a lot of boxes in terms of like good management team in place for a long time, generate high returns on invested capital, balance sheets clean, you can see the free cash flow. It's a bit more capital intensive, right? So they actually do something in the real world in industry. But it, ticks all the boxes. But what we could never figure out initially was like, so this is a company that basically sells fasteners, right? Screws, bolts, nuts, that kind of thing. And you're like, well, how on earth with a commoditized product like that are you earning, returns on capital in the 20s to high 20s, right? And again, that's when, sometimes you can look at the numbers and you go like, well, either something here doesn't make sense, or you can say qualitatively something here doesn't make sense. Let's go and find out maybe we're viewing this business incorrectly. And I think the way to think about Fastenal is they provide a service to their customers. So again, it's sort of that, key critical component, low cost to value kind of thing. But if you are manufacturing any piece of machinery, and for want of a single type of screw or fastener, you cannot actually complete the product, finalize it and ship it, then, and if that doesn't happen, you've basically, your production facility is at a standstill, you will pay a lot for someone to make sure that there is just-in-time inventory of every single type of fastener you need. So what they basically really do is they provide a service. They effectively provide a service where they are a outsourced inventory just-in-time sort of solution to their customers, to the point where in many cases they actually have physical square footage on their customers' sites, and they replenish those, and they've got someone employed there to basically help, when people come in. Another thing they do, for instance, is they've got these vending machines, like you would like buy a Coke or something, and you basically tag in, and you press the button for I need this product, and then it issues that to you, but it tracks who's issuing it, right? Now the interesting thing about that is they actually create value at their own expense for their customer, because as soon as you start tracking that digitally to the extent that they can do it, then turns out that people are no longer as willy-nilly about sort of saying, well, I need 5 pairs of gloves or whatever the case might be, because then people go like, well, why are you taking 5 pairs of gloves? Like, are you like losing them? Are you taking them home? What? Yeah. And so what actually happens is they sell their customers efficiency to the point that when they do an install of one of these vending machines, they actually, for the first year or two, probably see revenues come back a little with that account because they're deploying the inventory more efficiently. But then obviously over time, you create the sort of surplus for your customer, and they tend to consolidate spend with you. So as soon as you sort of figure, oh, that's what this really is, and that's how the value is created, you tend to start looking at it and saying, well, it's not so much a provider of commodity parts into the US industrial landscape. They provide a key service. And once you've standardized with them, you're probably very unlikely, you need a very high reason to switch away from them. And it's not someone else coming along saying, I can do it for 10% cheaper, right? It's about the efficiency gains and how they make your operation better.
One thing I realized here we haven't really touched on is management teams. So in businesses like this, like execution is important, right? And not over-capitalizing on inventory, on those types of things. You mentioned it earlier from the capital allocation piece around, are they putting money in the right places? Are they getting that return? And you talked about Microsoft. How about just generally speaking, what are you looking for when you come across a company, say like Fastenal? What are you looking for in the management team that would give you conviction in the business?
Well, look, so I think in general, not speaking specifically to Fastenal, but if you look across, management incentives are hugely important, right? So we definitely look at how management gets paid, because if you're paid on something like a sales growth number or earnings per share only, then there's always the temptation to basically just, do dumb acquisitions to hit the revenue target or, juice the EPS number, right? So we would prefer to see management, firstly, that they're aligned with owners in terms of having an ownership stake. Now, again, when you talk about a gigantic business like Microsoft, you're not going to have the CEO own 10% of it, right? Like they would basically have to spend $200 billion plus buying that stake for them. So that's not going to happen. So what you look at, we would say, is you need to look at track record. You need to look at incentives, and then you basically need to sort of make sure that management are transparent and honest stewards of your capital, which sounds like a lot of sort of stuff that's up in the sky, but briefly, let's quantify it. Capital allocation mostly happens in terms of saying, so you can track sort of what your incremental returns on capital are since present management took over, and you can form a view on whether they're good at buying or whether they tend to pay up and how do they integrate deals. So, that's one piece. Again, the proxy materials every year would give you at least some sense of how they're incentivized, and, be very cautious, we would say, when the incentives, we're not saying management teams who don't have a return on invested capital metric are by definition going to do something silly with shareholders' equity, but they are more likely to, just given that there's scope for them to be remunerated if they do it. And then finally, it really does come, you talk to customers, you talk to employees, you talk to competitors, right? And what I tend to find is if a competitor speaks well of a business or a management team, to me, that's usually a very strong signal that these guys are trustworthy operators. And it's not about saying that management never make a misstep. It's what happens when they find out there's a mistake made, or how they basically treat you as a shareholder when something goes wrong. If they obfuscate and sort of say, no, it's not a problem, red flag. If they talk in plain and simple language to you about what went wrong and what we're going to do about it, massive tick. And I'll give you a very brief example. So we don't own Zillow, but obviously in the news for various reasons. But I think a huge tick in the favor of management, the fact that they decided to end the iBuying business themselves, saying we got it wrong before, maybe it blew up. Because clearly that was the risk there, right? They were seeing that the algorithm wasn't behaving the way they thought, and then eventually you end up with saying, no, we're going to get this right, and you keep on pursuing it, but you drive it off a cliff in the end. To actually say, we got that wrong, and we're stopping that, I think speaks very highly of management there.
Yeah, Zillow is an interesting example. Another one that's probably the example is Berkshire. And you brought him up earlier on, Warren Buffett, and you sent me some notes on Berkshire before the conversation. How do you I'm guessing every one of our listeners know Berkshire Hathaway, but I think the way that people view its outlook and just even how to put a value around the business is fascinating. I think that's the more fascinating conversation. When you look at Berkshire as an investment proposition, how do you go about pulling it apart and analyzing it?
So you definitely have to sort of go some of the parts, right? There's just no way. And I mean, trying to value Berkshire by sort of reported earnings where like wild swings in the listed equity portfolio like obfuscates the actual number. And I mean, last week we had over the weekend a result from them, and I on Monday morning we were laughing here because you could basically pick a different news source and you'd get a very different flavor of whether this was a good result or a bad result. Profit drops, I think 60 or 70%. Yeah, but that's because they didn't have the same mark-to-market gains as they had in the year ago. Versus operating profit up, I think 16%. That's probably a more accurate reflection of it. I think the first thing I would say about Berkshire today is that the most common misconception I still find when I speak to people about Berkshire is they think it's basically a listed vehicle to buy other listed equities, right? And the reality is that Berkshire has used their float in the insurance business and the capital allocation skills of the people at the top to make, you could still argue that Apple acquisition a couple of years ago is probably one of the greatest all-time single dollar value creators that's ever happened. But I think in this sort of raging bull market, people go like, well, what have you done for me lately, right? So look, here's the short answer. You look at Burlington North Santa Fe, the railway, there are other comparable US railways that are listed separately. So, you can compare, those valuations, but you can also form a view on the fact that, no one's building a second set of rails right next to BNSF and thereby eroding, their returns on capital. It's a more capital intensive business. And I take the point that people are concerned about sort of, the sustainability and ESG concerns. The reality is that, shipping stuff by rail in the US is probably one of the more environmentally friendly way of moving goods. And there's nothing that says you can't electrify your rolling stock, right? Berkshire Energy is a very interesting business. So, they bought it and they sort of cobbled it together from a whole bunch of acquisitions over the years. The interesting thing there is that the allocation to renewables, I speak under correction, but I think it's around about 40% of generating capacity, and that's going up. So the incremental dollar is going into the renewable stuff, right? And because Berkshire parent does not need a dividend from Berkshire Hathaway Energy, means that they can, tender and bid for projects that, other listed utilities play that have to sort of make the annual payment of dividends simply cannot. Then you've got the insurance operations. Again, valuing insurance business is almost an art in and of itself. And I'm not sure that I want to bore your listeners with today, but again, you can basically use either comparable businesses, or you can basically use the sort of more traditional way of valuing insurance business, which is sort of looking at reserving and how conservative they are. They're very conservative, and sort of forming a view on, premiums written and how that's going to play out over time. And then finally, you've got sort of the big, let's call it industrial, the hundreds of little businesses they've got. That's probably the one that's most difficult to sort of place a value on, because they don't give you the depth of reporting that you would want. But again, like the annual report would be hundreds and hundreds of pages thick. So I think at some point it just comes down to the following. Our view on Berkshire, we literally bought it. That was, in the crash last year, we said to each other, at some point, the world is going to not be a disaster. And in that sense, you would probably want some exposure to an actual physical economic recovery. And at that stage, I think Berkshire was trading about, 1 times book, which is for a high quality company with a fortress-like balance sheet, it gives you a lot of comfort. I think it comes down to sort of saying, well, what does it do in the portfolio, right? Our view was it gives you a broad-based exposure to a US industrial recovery and over time development without having to sort of try and pick a winner, because at that stage, you just didn't know how things would pan out. And it's backed by a rock-solid balance sheet, and you've got optionality because you've got good capital allocators at the helm. Turns out, because the Fed acted so aggressively, that stuff didn't stay cheap for very long. So that's fine. They're buying back their own stock right now. We think that's capital allocation at Berkshire remains good, right? So they're buying back their own stock. They're terming out their own debt. That's really good sort of capital allocation principles. The reason we own it still is because we think there's still more to go in sort of the US economic recovery. And if things really do go to hell in the handbasket, to put it frankly, what you want to own, in our opinion, are businesses that have excess cash on balance sheet with people who know how to deploy it. Because then finally, when valuations reset downwards because of rates having to rise or whatever, you'll be able to sort of see them deploy the balance sheet. I would say one of Berkshire's key sort of competitive moats for a long period of time was the fact that they invested the float so well. And effectively, they had access to cheap funding, or funding at negative rates, effectively, right? With interest rates where they are, private equity or, there's tons of other people. Berkshire is no longer the incremental provider of capital to a distressed business or even a cheap business, quite frankly. If rates ever go up, Berkshire is still in a very good position, we think, to allocate capital. And again, you have to think about Mr. Buffett, Mr. Munger, they're not going to be around forever. I think this year at the AGM, they sort of said what's going to happen there in terms of succession, and we're very comfortable with what's going to happen there. So is it a bit boring? Probably. But again, if you put your IRR hat on in a world where, government treasuries are paying you 1% to 2% at best at the moment, Berkshire, we think, is going to earn you somewhere between 8 and 10, maybe 11% ROE consistently without blowing you up because it's so well capitalized. I'll take that. It has a place in a portfolio. I mean, I tend to think in rugby union terms because I'm South African, but is it going to be the sexy, exciting story? No. But if it can earn you a respectable, 8 to 10% in the world where interest rates are 0 per annum, we definitely think there's a place for it. Does it always have to be top 10 holding? Probably not. But again, you can use it as a funding source as and when you see other opportunities.
It's fascinating. I haven't heard anyone talk about it in those terms, in that kind of that funding. Like, you could go to Berkshire as your last resort, or they are the distressed funder of your business. With interest rates coming down, that's slipping away. I hadn't thought about it in that respect. One of the things that we all know from Warren Buffett and Charlie Munger is basically a circle of competence. Yeah. And I'm just wondering if there are companies that you can think of readily where you've gone outside your circle of competence and what you've learned there.
Yes. What I've learned is don't. Look, so I'll be honest and say this is sort of all experiences from the last decade, and to be fair, it's not about saying anyone got it wrong, because in the cases I'm about to mention, it's not necessarily, again, I was sort of the tech analyst, but when these decisions were made, it was in the fund that I was helping to run, so you have to own some part of it. But I think some lessons. One, it's a US oil services company. I'm not going to mention the name because the people who run it are, honest, hard-working individuals, and there's nothing wrong with it. But the point was, this was sort of during the shale boom. And then obviously you keep hearing from people, well, what are you doing in US shale? What are you doing? It's an energy revolution, all that kind of stuff. And then, you end up getting someone who's an energy analyst, and they scour the universe and they come back with a stock pick. And, we kick the tires and go like, yes, this is, best pick and shovels play, and we buy it. It works for a little while, and then obviously the energy boom kind of went bust in a big way. And then, it tapped out, I think, about $120. We eventually ended up leaving at about 70. It bottomed at about somewhere in the 30s pre-COVID, right? I think the lesson there is very much, if you are looking for high return on invested capital businesses in industries where you can kind of understand the supply side, because if you do anything in commodities, you have to be thinking about the supply demand economics all the time. Whereas the businesses, I would say, I have a much better understanding personally, and therefore are comfortable investing in, are businesses where you can form a more definitive view of what's happening on the supply side. So to allude to my earlier point, no one in 2021 is really trying to create a new desktop operating system. There's Windows, there's Mac OS, there's Chrome OS, and maybe there's Linux, right? No one is trying to sort of reinvent that particular wheel. No one is replicating a heritage luxury French brand in 2021. Louis Vuitton is Louis Vuitton because it has heritage, right? So I think if you think about it in those terms, you immediately just put a red line through a lot of businesses. So the one that I just mentioned was a salutary experience, because it basically told you, if you're going to play outside your traditional wheelhouse, you should be very, very careful. If you sort of then build this narrative and the lesson there was, do not try and forecast demand, you will get it wrong. understand what's going on the supply side, and if that changes dramatically, that's probably a risk. Another business I'll briefly mention. This one I'll mention by name simply because it's difficult to hide which one it was. AB InBev, right? So AB InBev buys SAB. When was it? 2016, I think. I mean, it was pretty clear that they were overpaying, but there's two lessons there as well. So the one is like capital allocation. You're building an empire, brewing empire, biggest brewer in the world. It's pretty clear you're overpaying, and at the same time, you load the business up with an enormous amount of debt. And I think the lesson there again was, even though this was a traditionally very stable business, and they would have been expected to manage through and work down the debt, for a variety of reasons, not all within their control, they were just slower in sort of beginning to work that down. And then I think literally very shortly or just around when the SAB deal closed for a long period of time, AB InBev just underperformed. And I would argue that a large part of it was due to the fact that they were so encumbered by, the tens and hundred, I think it was about 100, just over $100 billion of debt. Like, you just don't have the capacity when you've got that amount of debt to be nimble in the face of competitors who are picking away at niches, right? Yes, they had some structural issues in the business, but man alive, like when you're that indebted, your ability to maneuver and respond competitively is just vastly diminished.
Well, if you look at all of the things that you've talked about so far, from right down from intangible assets and Microsoft, and that optionality is key. And you talked about like balance sheet risk earlier on as well, and how you assess that. A fortress-like balance sheet gives you optionality, right? Even if you've got nothing else going on, you've got the ability to deploy capital in interesting ways.
Yes, and I think that's a key. Like, the one thing we're thinking about very carefully right now, just given where valuations are, and everyone's very worried about is the Fed behind the curve? Do interest rates need to go up? To be brutally honest with you, I think everyone is sort of taking their best guess. No one is 100% sure. Like, people get by and wanting to be sold certainty, but the reality is none of us are 100% sure about this at all time. What we're doing is sort of saying that strong balance sheets do two things. When things get tough, they mean you stay in business. To my earlier point, cash is like oxygen, right? And everyone found that out the hard way last year. And if the Fed didn't reopen markets to be able to raise capital, it would have gotten really messy. But secondly, it provides optionality in those moments, because then you finally get people who know how to allocate capital in value accretive ways to actually deploy the balance sheet. So absolutely. I think it's an unappreciated source of like portfolio resilience in moments of crisis, because when that happens, you can't model it, you can't forecast it. But if you've got good capital allocators at the helm and markets correct dramatically, you'll wake up one day and see these guys have done something in line with the principles that they've espoused over many, many years.
I'd like to finish off with one company, which is a company that you mentioned at the very start of our recording. And this goes back to your South African days, where Naspers, you're covering that, you knew about it, and its investment in Tencent, which many of us know today. Can you describe that, I guess, how that business has evolved over time? And I think some of the conversations or commentary you had is basically the challenges in EM as well for a lot of investors right now.
So I think that Tencent has been a really good business for a really long time now. And I think it obviously, I remember in the early days of looking at it, it wasn't, the gaming colossus, the WeChat colossus to the same extent it is today, right? It started off as a very different business, and then its big sort of moment was when it started transitioning to mobile and being a lot more mobile friendly, because, we asked, investor relations, quite frankly, the question like, well, what happens if, you're very strong on PC games and sort of chat and PC, but what happens if mobile, as it seems to be, is going to be the next frontier? And, they managed that transition very well. And I think what's happened with Tencent over the decade is that, they built out that sort of, in China, WeChat is essentially the center of your digital life, right? It's how you chat, it's how you stay in touch, and they've added on, so let's call it in the traditional sense, line extensions, added on to the functionality of WeChat to make it, an incredibly sticky user base. So look, Tencent historically great business. It's one that, we own some part of it. The story has obviously become a lot more tricky recently. So you had sort of an initial bout of government regulation around gaming back in, I think it was 2018, and then more recently we've had another round of it. Look, I think that the discussion we have when we think about Tencent today is, you need to be clear who's allocating capital and for whose benefit it's being done. So we got worried earlier in the year about exactly that issue. So we were reasonably fortunate enough to downweight in April for reasons that were unrelated to the sort of crackdown that happened later, but it hasn't killed us. The debate we're having internally, and I mean, they literally reported results last night, so we'll have that debate probably this afternoon, is to sort of say, well, it is cheap on historical metrics, but what is the right multiple, for lack of a better term, but what is the right discounted cash flow valuation today if, regulation essentially means it may no longer be as super profitable as it once was, because then this could be a fair valuation, right? And I think the lesson there, and one that I can sort of speak to, having at least lived in an emerging market and traveled, at least for business a little bit, in Africa as well, is to say the people tend to go, oh, EM, you should allocate to EM, right? EM is cheap, EM is a great opportunity. But that tends to sort of lump a lot of ideas into one very simple word, which is EM. The reality is that corporate governance in EM, in many cases, does not provide you with that sort of same, let's call it, shareholder protections as you would in developed markets. And I have a former colleague who always used to tell me, and he invested in Russia in the 80s and 90s, and he'd say the thing you need to remember is that in emerging markets, the rule of law is like a light switch. It's an assumption you make that it can protect you as an investor right up until someone flicks the switch, and then you'll find that a lot of founding assumptions for what happens in your investment case after that no longer holds true. So with Tencent specifically, I think we're reasonably clear-eyed about the risk here, which is effectively, essentially, it becomes a no longer run for equity owners like ourselves. If that's the case, you're best to move on. But it is a really, really good asset. Given the valuation, we sort of said, look, we've given it some time to see how this develops and how it goes from here. I think in general, the point I would just make is that, mandates notwithstanding, we have a global mandate, so we can certainly buy anything in an emerging market. And to be very clear, there are very good, honest, and honorable business people in emerging markets around the world. But if you think that EM as the sort of homogenized concept is cheap and you should just allocate to that, what I've found practically is that effectively buying multinationals domiciled in developed markets that know how to operate in those countries and know how to do so well is probably a lower risk way of trying to gain that same exposure through time, and not, wake up one morning and see, a regulator somewhere has changed, at a stroke of a pen, virtually a large part of your investment case. So again, I think it just speaks to sort of that it's other people's money mindset. If I wouldn't take the risk with my own money, then I'm sure as hell not going to put someone else into it to sort of say, well, if it comes off, aren't I clever? And that really is sort of the approach we take. If it makes sense, you'll invest in emerging markets, but you have to have a pathway to a higher IRR to be compensated for it.
And so you effectively in your modeling, you would say, obviously you've got the risks that you could watch metrics react and watch regulation and have that impact on the income statement or the cash flow statement or balance sheet. But you're effectively adjusting for that uncertainty, just giving yourself a wider, a more generous, depending on how you frame it, generous discount rate and risk weighting associated with that company.
Yes. I think there's another interesting point which is worth highlighting, which is sort of to say that in decision theory, there's this idea that there's risk and uncertainty, right? Risk in classic decision theory is the idea that probabilities are known. So in other words, if I roll a dice, it's going to be one of 6 numbers. So, we can probably say, well, the probabilities to that event is reasonably known. Uncertainty implies that the outcomes are not known. And you cannot actually assign probabilities to it. Or if you do, you're basically, sort of finger to the wind kind of stuff. And therefore, in a case like this, we definitely have sort of multiple valuation scenarios and trying to understand, well, if they can go back to previous levels of profitability, if they're capped at this level, if they, is it effectively a tax that you need to pay to play, as it were? and therefore, you bump up the tax rate and you have a high discount rate, all that stuff. But I think you also need to be reasonably clear-eyed about, like, sometimes the answer is not going to lie in a DCF, right? Because the risk is not modelable, for lack of a better term. And in that case, we sort of try and sort of have a more holistic view of sort of saying, look, is there a better use of this capital? How do you deploy it? Because again, you can sit in this thing for years. I'm not picking on Tencent specifically, but in a stock for years, sort of saying, well, it's cheap, but on a sort of meta-analysis level, it's not particularly, like, there's no catalyst for why the thing should actually start working, because the risks at that level, the uncertainty, cannot be answered, and you'll either know the day you wake up and it goes away, or the risk materializes. And at that point, you're probably better off at least saying, look, what are your red lines? And if these qualitative things happen, that's it, you're done.
I'm going to catch you off guard with one final question, mate, which is, if you could go back to your younger self and tell yourself with something about money, finance, or investing, what would you say?
About putting away more earlier, and depending on which time period you're allowing me to go back, I would definitely say buy Apple in the 90s, and I would say buy Amazon around about 2004, 2005. But I mean, slightly facetious. No, I think the honest answer is, like, it's amazing the effect time has on compounding. And I know everyone says this, and intuitively we all sort of nod along going, like, isn't that compounding, the power of compound interest? Like, but when you actually sit down and do the math, so we did a thing recently where we sort of said, look, and this is obviously a very idealistic scenario, but if you start with, $1 million and you just compound for 20% for a long period of time, right? After 5 years, you've basically 2.5x your money. But after, I think, 30 years, I think you're at either 90 or 900 million. Sorry, I'm blanking on the exact number now. But the point basically is more than 60% of that return happens between year 25 and 30. And that power of compounding over long periods of time is what I wish I had discovered earlier. Because in the beginning, I was very much like, okay, you need to find businesses that are going to work this year. And they go, and again, that's what they sort of, at my former employer, hopefully beat out of you over time. It's not about, like, what's working right now and sort of being able to stick, like, you are here to compound people's wealth. If we get that right in a reasonably low risk way, they end up in a way better position than sort of trying to win that annual horse race of performance thing. So, I would just say to myself, start early, understand the power of what it is if you get it right, and focus on that end goal more so than trying to, solve for the bits in the middle there where you, like, sometimes, under the pump a little bit because, you may be a couple of percent behind the benchmark in a particular given year because your style or the type of thing you want to own is just not in vogue that year. Like, the end goal matters. That's the trick, I think.
For sure. Etienne, thanks for joining me on the show.
Thank you so much for the opportunity. It's been a real pleasure.